No crying at the casino. You've seen this phrase plastered under Twitter posts, YouTube videos, whenever someone's complaining about a trade gone wrong or a bet that didn't pay off. But here's the uncomfortable truth. Most people crying aren't upset because they gambled and lost. They're crying because they didn't even know they were gambling in the first place. In today's episode, we're going to be dissecting the dangerous illusions of risk-free trades and ignorance that can happen in the early years of trading. We'll be going over the XPL disaster that wiped out millions from certain traders because they didn't understand the underlying token that they were trading. We'll also be giving personal experiences of when we've made trades that we didn't understand the underlying risk and ultimately paid for it. You'll learn why even some of the most sophisticated traders get blindsided by these risks and don't see them coming. Let's uncover the risks no one tells you about. No crying at the casino is what you'll see under a lot of Twitter posts and even YouTube videos when people are upset either about taking a gamble, taking a bet, or trading as well. Ultimately, there is no reason to cry at a casino because you've accepted your risk and you've placed that risk on the table, and you have to be fine losing it. In this podcast, we want to go over a couple of examples of where ultimately there was no reason to cry at the casino and how you could have maybe prevented these situations beforehand, or how to properly analyze your risk before even putting on a trade or a bet. So I think I'm going to move it over to Pedmo because I think he has a great example that happened recently on XPL.
Yeah, so last week there was a few people like that came to Twitter to cry about a position, right? So to give a very brief example, you have a perpetual contract, like a perpetual futures contract on chain that is trying to track a market that doesn't exist yet, right? So let's say that you have like an ICO, like an initial coin offering coming up. Like imagine that someone is going to launch a coin next week, and you make like a pre-market like type market for people to make bets on, right? And so there was this market that was on XPL, and it was a lot of people made a lot of trades for a bunch of reasons. One were trying to hedge their initial their airdrop that they got for that coin. Others were trying to farm the funding rate for that coin, so it was paying a very large funding rate. And what people did was they tried to make this delta neutral position, right? So they put a short on the exchange that paid the highest funding, and then they put a long to edge that position on the exchange that was not paying funding or was paying very low, so they didn't have to pay that funding. And they were dealt what is called the delta neutral position. So their net exposure, so their long minus their short, so they're zero. So they had theoretically no risk to market impact, right? So if their net position is zero, if the market goes up, they make money on the long. If it goes down, they make money on the short. The thing that was very interesting about this is that these are pre-markets. There is no underlying asset that exists. So one market can, if can trade at a certain price, and another market can trade at another price, all for the same asset that doesn't exist yet. And this creates these interesting dynamics where people thought they were delta neutral, but they had an underlying risk that they didn't assess. That is the risk that these things are not pegged to each other, so they don't have to converge anyways. And all of this information, like might be a bit confusing, but we're all on the documentation for that contract. So if people took the time to read the contract, they would see that these almost trade like different assets. And on the short leg, it's basically someone at night, when there was very little liquidity, just punched through the order book and pushed price higher, liquidated a bunch of shorts, and made a profit doing that. And people were like, oh, but I was delta neutral and I lost money. So, and they learned that delta neutral doesn't mean risk neutral. There's always inherent risks to this type of trading, even if you think that you have no exposure to the market. Maybe I'm getting a bit extended here. What do you think?
No, I think you're completely correct. I kind of wanted to sum it up into three things. Also, some examples from my own experience because I don't only want to shit on other people. I'll also talk about the mistakes I've
No,
made. But
I want to just make a point clear. I'm not making fun of anyone. I'm just saying that sometimes you think that you have something that is risk-free, and in reality, nothing really is risk-free. And there's always some underlying risks that you are not accounting for.
yeah, completely. So I was going to say, yeah, like number one point is that all these sort of mistakes, they come with a lesson, right? And I think In trading, those lessons you actually have to pay for. Like most of the time, you have to hand over money, and then you're actually going to get a lesson back as long as you're ready to learn and to accept it. And I think this is a great example of them. Like a lot of people thought they could just hedge their current position, but they didn't understand the underlying thing that they were trading, and that's a very big mistake. A very easy example for me to just pull from is I remember the first time I got into a small caps hole. I was quite young getting into it, and I was being a bit stupid. I just liked the volatility and I wanted to trade it. I remember the first time I had a position open. I had, I think, 3x leverage on, which at least in equities is quite a lot. And I was stuck in a hold, and I had no idea what was going on. I was like, why is the stock not moving? Why is the order book completely gone? Why is my P&L fluctuating by so much? Like, what's going on? All these sort of things. And ultimately, it was because I had no idea what the underlying thing I was actually trading and how it worked. So obviously, from then on, I understood halts a lot better, and I researched them a lot more. And that was the key lesson. Luckily, that halt didn't cause me to lose a lot of money. It basically unhalted and just went right back to retrace. But that could have been a very nasty situation for me. It could have been a very similar thing where I had put all my money on that, and it just holded 4 times higher, and then that account was fully gone. So number one lesson, definitely always understand the underlying thing you're trading, even if it seems boring. Like understanding how futures contracts work, all those sort of things, especially in crypto as well, very good thing to do. It's kind of like reading the dictionary. No one wants to do it, but you actually will learn a lot from doing it. So it's just one of those things you have to do. The second example I actually want to give is a similar one where you can have a very good backtest, right? You maybe could have optimized it a bit. I'm not even going to touch on like overfitting. But let's say you have a very nice backtest, but you then take it live and you suddenly see that it's not making money on really any of these trades. You're not 100% sure why. Most commonly, that's either going to be from slippage or execution fills. Depends on how high frequency the strategy is. And a lot of times, no one takes that into account the first time they backtest something. Maybe they've watched other videos, maybe they've heard about it from that, but instinctively, a lot of people, when they like to backtest maybe through Excel or manual backtesting, all those sort of things, they'll add either a very arbitrary version of slippage, or they won't add any slippage. Now, sometimes that can be fine, because if you're trading a very small account size on something that's very liquid, you'll probably will get filled pretty much on the same price. But if you're even trading something that's a bit less illiquid, or for whatever reason you're trading a decent amount of size, that difference in fill is going to cause a lot of issues, and you most likely will be, as we're kind of saying in this episode, you'll be crying at the casino, because it's going to feel unfair. It's going to feel like, well, if I'd got executed at this price, this would have been a profitable trade, all those sort of things. But it's just one of those things you have to learn from, and it's one of those mistakes, and then you learn that lesson and you build from there.
Yeah, I mean, the issue is not even making a mistake. It's just going then on Twitter and other places and crying about this. That's why it's funny, like saying no crying at a casino, because you put on the risk, you wanted the reward, everybody wants a reward, and then when you don't get it, you go cry publicly, and that's why there's that phrase. And yeah, those are like the next example I was going to give is like FTX, right? Everybody was making a ton of money on FTX because there was so much like yield there, like just stuff that was purely, again, delta neutral, like without directionality. You were just making funding arbitrages. You are arbitraging coins from one exchange to the other. There were so many opportunities that theoretically you took no risk on. You could make both legs on, like a long and a short, like we talked about. And in the end, doesn't matter how much money you made. All it matters is how much money you took off the exchange, because if you didn't, you took any, you went down with it, even though you made a lot of money doing these things that theoretically were delta neutral or directionally neutral. And once again, another example that there's, even though you can structure these trades to be like that, they don't mean they are risk neutral. There's always like third party or other stuff, like other risks that we don't factor in all the time. Like getting your, another example is getting your wallet exploited, right? We can have a very good opportunity on chain, like almost certain money, easy money. I was hearing a trader talk about that they found like a bunch of edges that were practically free money, but it's never free. You are still very exposed to smart contract risk, to being exploited on wallets, to signing transactions that you don't understand. There's so many risks. Nothing is really risk-free.
Yeah, because I think like two common traits of a very good trader is one, skepticism, and then also curiosity. Skepticism can kind of breed, I guess, curiosity in some essence, that if something seems too good to be true, there's probably a catch. And maybe it's not as big of a concern for you, but there probably will be some sort of risk that you're taking on that you don't know about, or you don't really fully understand. And I think that's also why, over time, as you get more years into trading, for the most part, you're going to lower that amount of ignorance, right? There's going to be more things you encounter. There's going to be more crazy situations you've seen. There's going to be more things you've heard of. And if you can learn from other people's experience, plus also um, not be incredibly lucky in the sense where, like, for example, the XPL trade, right? A lot of people are putting on solid size on that, and they've
Yeah.
obviously done good in previous cycles, or they've done good in business, or whatever, right? Like they've had some sort of lucky streak, but they have never encountered that sort of risk, and they may have a ton of experience. They may have been trading markets for ages, but they ultimately haven't been exposed or understood that risk. So while yes, more experience or more years does mean you've encountered more things and you've seen more things, you still can always be caught off guard. Like, trading is a defensive game in the sense where you do need to understand what you're trading and also what risks you're putting on. It's also why we always talk about, if you're deploying a strategy, you need to understand, why is it working? What are you exploiting? What are you taking advantage of? What thing are you participating in? Are you participating in something where you're taking advantage of someone that's price insensitive, and that's why it's working? All these sort of different ways. It's about understanding the underlying kind of mechanic.
Yeah, even I was at the gym an hour ago or so, and I was hearing to this podcast of this crypto trader, and I found it very interesting because one of the things that he does, he audits himself, like he audits like the smart contracts with on all like interactions that he does on chain, which is very interesting. It's something that I cannot do because I don't understand solidity and like other programming languages, and it's something that I must improve because not I always rely a lot on trust or see that others also use those protocols, and it's not always the best way. I want to be able to myself like stress test if my money is really protected. For example, Sonic is a chain that was giving early adopters points to later on have an airdrop, right? And they had like one protocol inside Sonic, which was like some yields that they were providing on stable coins or whatever they were doing. It was on stable coins. On this type of stuff, I put very little money on. I spread my money very far, and they were paying like they were paying like 50% APR or something. And I just want to farm their point because it was a very small protocol with just a few million in TVL, and I put 1.5k in it, which is a standard like very low high risk type stuff that I put on. It's not much, but and if you put into a bunch of things, let's say you put 20 of those in a bunch of them, you are less risk at one blowing up. Anyways, I put 1.5k. I look it over after a few months on it. I go to see that the founders said that they were exploited or whatever, and they were closing up the shop, and I lost the 1.5k. Now again, I have very tight risk controls when it comes to this discretionary position, so I had very little capital, and yeah, but I didn't understand, and it's something that was almost free money, right? It's a stable coin yield. Supposedly, it's free money. Theoretically, you're not exposed directionally, but at the same time, it's I still got caught in it and lost it. So that's it.
Yeah, no, I think also like a good example of that in the equity space, or I guess in most markets, is like shorting volatility and those sort of strategies, right? Which are very big tail risk sort of strategies
Yeah,
where, my God, the amount of Twitter posts I see where someone says, if you have a 500K account and you do this option strategy, you'll make this amount a month. And they don't understand that there's an underlying risk there, right? Like they just don't see that, yes, maybe it's a low probability, maybe it's a low amount of times it's happened, but it's still a chance that you could blow up the whole account or worse. And if you if you don't understand that when you're getting into it, it can seem like fairies and roses. It seems amazing. You can make 7K per month on 500K. That's a great return, but that's not the truth. And you're making that return for X period of time because you're taking on this huge other risk that you're not even aware of. So those sort of things I think are very good to understand. Also, that's not necessarily saying like never do that strategy. You just need to understand that's the risk you're putting on. Maybe it's you're fine putting on that sort of risk, and you know that you need a lucky sequence or a good amount of time, and then you can grow a decent amount of or a small account into a decent amount of size, and then pivot to something else. There's a lot of great ways to do that, where you start with something a bit more risky, you're fine losing account and kind of maybe restarting it a couple of times, but then you pivot into something that's more long term or lower risk or less tail risk, all those sort of things, which I think are important to understand.
Yeah, just no crying at the casino when you blow up those
Yes.
500K. Don't come on Twitter saying, "Oh, shorting volatility is this or that," or I got to, it's like it's very bad taste.